Hey guys, so recently there's been quite a few changes coming up for the long-term care tax here in Washington State. So this video just want to give you a couple of brief updates on what they are and some proposed changes that are on the table that we could see pass in the next few months. So if you've missed the news recently, the governor has suspended the collection of long-term care premiums. They were originally supposed to be starting in January 1st of 2022. They have now been delayed until April. So there will be no premiums collected for long-term care tax until April. The reason behind this is because they're still trying to work out some of the kinks and complaints that exist in the plan. Now, we all know this plan is anything but perfect, and there's a lot of loopholes and just things that plainly don't make sense, and they really should put a lot more thought before implementing this program. And being that this whole thing passed back in 2019, many people didn't even realize it was about. They had 3 years to work on this, and they still couldn't get the thing done. So all those issues aside, it's nice that these issues have now become public, and the long-term care committee has notified the legislature of these issues, and they're going to try to work out something before implementing this long-term care tax. Now, whether or not we even see this long-term care tax is still up in the air. Now, the state has faced multiple lawsuits from this tax, the main one coming saying that it violates ERISA law and that it discriminates against people based on their age. So one of the key issues with this long-term care tax is that people who are near retirement are going to have to pay into it, but because they don't have 10 years into the system, they don't get a vest, therefore they receive no benefit. So that's one of the lawsuits that's come up, and probably the main issue that they've outlined that legislature needs to fix before this goes into place. The other thing is that there's a petition going around to make this long-term care tax optional. So if the petition gets enough signatures, we could potentially see this come up on a future ballot. So the Long-Term Trust Commission recently have been getting together at least once a month to talk about these issues and some potential solutions. So they put together a report, which I'll walk you through right now, that highlights 8 key areas that they want to see some kind of action changes made before this long-term care tax goes into place. Now, whether or not legislation is going to act on this is still up in the air. But first, let's just walk through what those 8 areas are and some potential solutions that the committee has recommended the legislature to think about. All right, so here's the commission's recommendation report. I'm just going to kind of quickly go through it. I read it all in advance, so I'll give you guys kind of the Cliff Notes version. If you wanted to read it through yourself in depth, the link will be in the description below. So if we fast forward down here are the 8 key areas that they want to talk about. So the first and foremost is people near retirement. So we kind of briefly touched on that. So basically, anyone that's near retirement that's not going to have the 10 years to fully qualify for benefits, that's what this issue is mainly concerned about. So one of the workarounds to this that they've kind of recommended to the legislature is that allowing people to retire before the 10-year contribution and still pay into it, and then once they get their 10 years, the payments would stop. So basically, if they went with this option, someone could retire, say 1 or 2 years after this program had started, and they could still opt to continue paying those premiums, and the premiums would be based on their average payment that they're making while they're employed. They'd pay these up until 10 years, and then it would stop, and then they would be entitled to full coverage. So that's what the commission has recommended as option number 1. Now, there are pros and cons to this proposal, which they've outlined here. The main one is that it's going to help the retirees that are near retirement actually get some kind of coverage. It helps address the potential lawsuit that claims that they violate ERISA based on age. It also gives the potential for retirees to have an affordable way to get private long-term care insurance, where else they wouldn't be able to qualify for one on their own, either through they can't afford it or for health reasons. As far as the cons go, they list a few of them here. Mainly it's that it's not fair for future generations that they pay into it for 10 years, and then that there's pressure on the premium rate. Now, some other workarounds that they've proposed is that allowing anyone born prior to 1966 who paid in for at least 1 year to qualify for a prorated benefit. Now, this option also makes a lot of sense. So someone that paid in for 1 or 2 years could get action to a portion, not the full benefit, but at least some of it. So at least their premiums didn't go completely to waste here. Other proposals are ones to have you continue coverage up until you need benefits. Now, that one is going to be met with more opposition because some people may not be able to afford paying it for a long period of times. So I don't know if that one's ever going to take any traction with it. The third one is just giving people the option to opt out. With the amount of resources and time put into this program, that's very likely to pass, but that's what that petition bill is trying to help push through. And the last one is just giving people refunds who paid in for less than 3 years. Now there's going to be complexity behind this, because what if someone paid in for 3 years, got a refund, and went back to work? So that's a whole mess. So I don't know if that's going to gain much traction after that. So the second thing they have to address are residents of border states. So under the current law, anyone that works in Washington State has to pay into it, but if you don't reside in Washington State, you don't get benefits. So people who live in Idaho, Oregon, or Canada, and they work in Washington have to pay into the program, but they're not eligible to receive any benefits from it. So that's an issue that impacts about 150,000 people. So one of the workarounds they propose for this is just to automatically opt those people out that don't reside in Washington State. Don't make them pay for a benefit that they're not going to see. This isn't going to be a permanent exemption. If any of those people were to move to Washington, then they would have to start paying into the fund. Of course, for that to happen, they have to employ their employer of their new address, and then they have to submit the taxes to the state. So that's going to cause some increased complexity for the employers. So that's kind of currently what they're thinking about doing. So the third issue that this thing impacts are people that are working in the United States under a temporary or non-immigrant work visa. So currently, if you work in Washington as a non-immigrant and you have your visa, you'd have to pay benefits, but because you still reside elsewhere, you have temporary employment in the state, you're not going to receive any kind of coverage. So it affects them as well. So the solution they've recommended here is just to allow these people to voluntarily opt out of needing to join this program. So a potential solution for this that they've looked at is just allowing people to voluntarily opt out if they want to be a part of the program, which makes a lot of sense. This voluntary opt-out would not need any kind of proof of private long-term care. Now, the fourth issue that they want to talk about are military members that have a 70% to 100% service-connected disability. So because these veterans have coverage through the VA that includes some nursing home care, it doesn't make a lot of sense for them to pay into another long-term care program if they don't even need the benefit. Now, the whole reason this program even exists at all is to help Washington State reduce their costs when they have to pay for people's long-term care expenses, because the state's responsible for half of the Medicaid payments when people go into care. So because these service-related people aren't really a burden on the system because the VA is taking care of them, it doesn't make sense for them to pay into it. So the fourth issue is just having a special exemption for anyone that meets these requirements. Now, the way it currently stands is that anyone that's currently 70 to 100% service connected could be exempted, but in the future, if you got moved to 70 to 100% disability, you wouldn't be opted out. So that's one of the issues that they talk about further in this context here. The next is for active duty military spouses. So because military families typically move around every 3, even 5 years, it doesn't make sense to have the spouses work a little bit, pay into this system, and then leave. Because the way this program works, again, if you don't have vested, you don't have 10 years in, you don't get a benefit. If you pay into it and leave for more than 5 years, you lose your benefit. So forcing the military spouses to having to pay into the system for a benefit they want to get doesn't make a lot of sense. So they're talking about having these people automatically get opted out as well. So item number 6 here is this constitutional amendment. So this section basically is just saying that the current tax is 0.58% of someone's income. When they did the actual assessment, they said that they needed to collect 0.66 for this thing to work. So this thing is underfunded from the get-go here. Now, in order for this to work, for them to keep the premiums low, they want the public to vote on having them invest the funds in the market. So basically giving control over to Washington State Investment Board so they can make a diversified portfolio for the holdings. The way it currently stands, they're invested in Treasury, which pays a very, very low interest rate, and it's not sustainable over the long run. So this section is really just giving the voters the option to allow them to put the funds elsewhere to potentially generate higher returns, which can keep the program going, but also may help keep the costs lower in the future. Now, 7 is exemption recertification. So this isn't the things that surprised me the most about this, is that when I had my wife go through the process to reclaim her exemption, they did not require a copy of her long-term care policy. They said, hey, do you have one? You check the box, yes. And a week later, she got a letter in the mail saying, yep, you've been exempted. Here it is. Now that doesn't quite seem quite right for me, especially for the people that went out of their way to make sure they got a long-term care policy in place and they got issued prior towards the November 1st deadline, all to find out that when they applied for the exemption, they didn't even need the policy in hand to begin with. That just doesn't seem right. The other concern here, and the thing that people ask a lot, is what if I get a policy, get this exemption letter and turn on and cancel the policy. So the way it currently stands is there is no plan to recertify that people still kept their policies all this time. So the Section 7 is talking about having a requirement of every 3 years to submit your copy of your policy showing that you still have it in force. So you need a new policy letter, something that shows proof that you're still paying the premiums and the long-term care insurance is still intact. Now, one other thing that this thing talks about is clarifying the established criteria for what a private long-term care insurance policy must include. So if you read through the original agreement, they specifically say that it has to be a qualifying long-term care insurance plan. It can't be one of these reimbursement programs. So it can't be one of those critical illness plans or chronic illness plans, ones that give you an accelerated benefit from your life insurance costs for costs you didn't yet incur. So because of that little thing in there, there's still a lot of companies that didn't have the right long-term care rider intact. They're still selling policies left and right to members, telling them that it does qualify. So they're going to look into this and really dive deep into your long-term care policy that you have to make sure it's the right kind. So what they're saying here is you can't just show us a copy of your policy. So what this bullet point here is really talking about is establishing criteria to make sure that the specific policy you bought actually meets the exemption requirements. All right, so the last section here, section number 8, is talking about people who qualify but then leave the state. So under the current law, the way it's written, it says that you need to have 10 years to become permanently qualified, but you need to live in Washington to receive benefits. So you put your 10 years, then you move to Arizona, and then you need care. You can't stay in Arizona and receive care from the Washington program. You essentially have to move back to get the benefit you've been entitled to. Plus, there's another thing that says if you're working and then leave for more than 5 years, you basically lose your coverage benefits. So even if you come back, you essentially have to start from scratch and have to put another 10 years before you become eligible for the benefits again. So Section 8 is really just them trying to figure out a way to provide benefits for people who do decide to leave the state, that put the money in, got invested in the program, and figure out a way for them to actually receive their benefits without them coming back to Washington. So they talked and they came up with about 5 potential solutions. None of them they thought were great enough, and they didn't even list what those options were in the report here. So this one's going to probably take a while to come up with a viable solution and put into place. So those are the 8 main issues that they're wanting to tackle. How much of that they're going to be able to get done before April is anyone's guess. My thoughts are they're probably going to address at least the first 3 or 4, and those have the highest media attention right now and probably have the biggest pushback on those exact options. Those are the ones they're going to address first before coming to the later ones here in the proposal. So I'll keep track of this and let you guys know with any updates that come out of it. Hope you guys have a great rest of your day. Remember that your future depends on what you do today.